Today's podcast is brought to you by Ryan, a leading global tax service and software provider that helps companies manage and minimize property taxes from acquisition to disposition and all points in between. As the firm with the most local market property tax professionals across the country, Ryan has experience in nearly every jurisdiction, unmatched by any other national, regional, or local provider.
Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, how are you today?
I'm doing well. We are about to reach May here, and I think as we've been chronicling in our bi-weekly episodes, it just seems like everything's, kind of gradually getting better. And we even found out today, de Blasio said that the goal for New York City is to lift all restrictions by July 1st. So that's,
Wow.
2 months from now, we're talking about nothing, full, for people who are ready for that, full theaters and everything. So it's just kind of wild that how quickly we're kind of coming around now.
Yeah, that's fantastic. That'll be great. I know that'll be a big sigh of relief for most people. Today, I know that you've got a special guest on the show, and that's Dori Nolan. Why'd you bring Dori on the show today?
So yes, Dori Nolan is the Senior Vice President of National Client Services with Berkadia, and brought her on to discuss the Berkadia Institutional Solutions, which is a new part of the company. So
Awesome.
Relatively new anyway. I think it's a few months old at this point, but still new enough to learn about. So Dori, welcome to the podcast.
Thank you very much, David. Thanks for having me.
Absolutely. How are you today?
I'm doing fantastic, and I'm excited to hear that New York City is going to get back to normal, hopefully by mid-time July. So that's fantastic. I'm in Salt Lake City, and we just lifted our mask mandate a few weeks ago. So we're slowly getting back to normal ourselves.
Yeah, it's nice to hear from, this podcast is a good chance to talk to people in all different parts of the country, and it's always just interesting to hear how the different paces, but also just like the general trajectory in the right direction for the most part, and that's been happening. And after the year we've had, I think we're all happy for that.
I agree.
I thought that the best place to start here is just even with what I started to talk about, but this Arcadia Institutional Solutions, for the audience who may not be familiar with the company or with this initiative. Could you just give us a quick primer on that?
Sure, absolutely, David. So in January of 2021, Berkadia announced the acquisition of the apartment brokerage practice of Moran and Company. The partnership launched Berkadia Institutional Solutions powered by Moran, which we're calling a platform dedicated to serving institutional investors nationally through Berkadia's existing suite of robust services and resources, combined with Moran's strong institutional investor relationships based on 3 decades of trust, client service, and collaboration. So we're pretty thrilled and excited that we were able to recruit the Moran and Company firm as a whole. We brought over 31 members, including Mary Ann King, who was Moran's co-chairman, to be co-head of institutional sales here at Berkadia. So just expanding our institutional capabilities has been a strong priority for Berkadia, and the Moran team's experience and just relationships in the institutional space are the right fit to launch this new specialty resource that will be dedicated to serving institutional investors. So with that, we are bringing even greater focus and dedication to and resources to our clients. So Berkadia Institutional Solutions powered by Moran, I know that's a mouthful, but it's important to keep the Moran name. We feel, for a period of time, we're thinking 12, 18 months, which then, we could then revisit at a later time, but we share a shared vision for our success. So together, we think we're going to be able to bring just extraordinary insights and to help our clients make better informed real estate decisions. And then they'll just benefit from our added value with the expanded team. And we feel that this will also propel some of our additional recruiting efforts in some other markets where we don't currently have a presence.
And so why was, you said it is a priority for Arcadia to kind of grow the institutional side. So why was that a priority?
It's been a priority because Berkadia historically it's been known as a mortgage banking firm for many years. So just looking at Berkadia and its predecessor companies, it really was originated out of GMAC Commercial Mortgage as a mortgage banking platform. And then it's grown into other firms over the years. And then on the investment sales side, Berkadia added a firm by the name of Hendricks and Partners, I believe in 2012, to really move into the institutional sales arena. And Hendricks and Partners historically was focused on more private client and mid-market type of investors. And up to last year, Berkadia's average deal size on the investment sales side was approximately $23 million. And when we looked at building the institutional practice out more broadly, we've been successful at adding advisors to help us with that effort. And actually, I joined in 2019 to help grow the institutional relationships as well. My background is private equity. I ran the investments platform for a firm called Capri Capital Partners out of Chicago that focused on fundraising for multifamily strategies in either a commingled or separate account format. So I was dealing with large public pension fund plans, and we would invest on a wholly owned basis or on or in a joint venture format. So I had a lot of relationships with institutional investors. So when we looked at the landscape, and just saw what we were doing, we could have, rounded out and eventually have gotten there, with some of the recruiting efforts, but it was important to make more of a wholesale acquisition. And Moran was a great fit, just given, just their historical footprint in the business, and their average deal size was $73 million. So marrying our smaller client and mid-market and entering into the institutional arena, coupled with Moran's prowess of dealing with more well-heeled institutional investors, average deal size of 73 million, we feel like we finally are a powerhouse and will be a successful advisory unit moving forward into the future.
So I don't know if you can name specific clients, but even aside from that, what are the types of the institutions that you are currently working with, or that Moran's kind of been working with?
Sure, they're the larger, more institutional clients. So just for example, some of I would say LaSalle Asset Management, Heitman, Invesco, some of the public REITs, Equity Residential, Amly, they're just a flavor of, some of the clients that Moran has historically worked with. And we've dealt with some institutional investors and have sold for them over the years, but now this kind of rounds out, some of the prior experiences that we've had, coupled with their, deeper relationships.
What are given that we've had this super tumultuous year, to put it mildly. I don't know if there are enough words to describe it, but we've had this year where different property types have gone through different cycles, where we've had massive, lockdowns, where there was so much uncertainty, where there was so much speculation about distress, et cetera, et cetera. Now we're increasingly at this moment where we know some of the subsectors that are performing well. We know some of the subsectors that were suffering that are now coming back. And we're even seeing, office, maybe there were some questions about the return to office. Now it seems suddenly like there's a lot more bullishness about that happening faster, and maybe offices will be okay. Just given like all of what's happening in the marketplace, what are the kinds of clients that you're working with? What are they looking to do right now? Are they looking to buy? Are they looking to sell? Or what kind of deals are they? How are they tapping into your expertise, and what kind of conversations are you having about navigating this marketplace?
Yeah, great question. 2020 was a year clearly categorized by disruption. When COVID first presented itself, really sidelined a lot of our clients just because they're more risk adverse, and we're looking for some guidance and some clarity on some bright spots of when to enter back into, the marketplace, and where and how, just because of, the fact that liquidity and risk is just so important to the composition of how they derive at their real estate decisions. But, we're still seeing institutional clients looking for diversification and how they kind of construct their portfolios, and what concentrations and property types and geographies and where they want to invest in the life cycle. I think that what we're also seeing is last year, a lot of the investors focused on refinancing. So our mortgage banking platform was extremely busy on the refi side because largely driven just by the low interest rates. But acquisitions are up 100% year over year, which is a good thing. We've been really, really busy. There's a ton of equity chasing as well as debt out there, just providing a lot of different capitalization structures for quality deals. And fundraising's been up, which is kind of like interesting, right? Because I think you would have thought that maybe fundraising would have been down, just given that folks were a little uncertain of, how long and deep the pandemic would have been. But nonetheless, fundraising efforts were up considerably, which has been good. But in terms of, multifamily's been the bright spot. So I don't think we can argue, as well as industrial, but we're primarily focused on multifamily. So I think that's driven just given the resiliency of the asset class, which was definitely challenged for sure. We've always talked about how multifamilies generated and provided the strongest income and growth characteristics and generated the most attractive risk-adjusted returns, according to NCREIF, over the last 25 years or so. But that came into question when the pandemic hit, and everyone was focused on collections. But the asset class has proven to be resilient and very hot right now, and just given demographics as well as just the long-term characteristics and fundamentals that we're seeing associated with multifamily.
And I think is it also true with multifamily in particular that the kind of the sort of the assets that the multifamily assets that the institutional investors would most likely be owning or investing in tended to perform fairly well. Like they were not the ones that had as much of the collections issues as some of like the smaller buildings or single or where the the tenants were more likely to have jobs that were disrupted or lost or coming and going. So it seemed like early on we had this like, oh my god, are people going to be pay rent? Then it turned out actually the tenants of the highest quality assets were pretty much able to work from home and able to kind of keep going, and so they didn't. And I think we saw those sort of numbers in NMHC's rental tracker from month to month, which didn't seem to come down nearly as much as I think some of us were afraid of when this all started.
Yeah, I think you're absolutely right, David. I think there was a lot of focus and attention on collections, but at the end of the day, people need a place to live, and I think they're willing to allocate as much of their capital or paycheck or savings towards having that roof over their head. And there might have been some consolidation with maybe some folks in one bedrooms agreeing to team up and find a roommate to share a 2-bedroom or whatever it may be, but largely the collection stayed pretty strong. And we've seen some shifts, like with the urban environments, in just the urban properties, occupancy may have shifted down with vacancies increasing, but generally, the collections, those folks who decided to stay were agreed to pay rent and pay current. And now, we're seeing, just some shifts, structural shifts from urban to suburban, and that's just given lifestyle preferences, just given folks have been able to work remotely or work where they, as long as they're near a phone and have Wi-Fi and access to living where I think they would prefer. We call that the untethered renter, which we're keeping a watchful eye on. That's probably a new term. I'm not sure if you've heard that yet,
No,
David.
that's a new one for me.
Yeah, so that's what we're watching now is how does that untethered renter perform, and just trying to get into the psychology of what will things look like post COVID in a more normalized renting situation. Will they go back to cities, or will they decide to stay where they are?
Yeah, I think that's definitely a thing that we've been trying to keep an eye on and assess, and it's just really hard to figure out. And I don't know, I feel like some of the, I mean, I know there's huge demand for single family housing and single family rentals right now, and then there's clearly been some shift. But I'm a big believer in cities and a big advocate for city living. I mean, I live in Brooklyn, so case in point. But I kind of feel like it's a little, I mean, I guess we're going to see it, but I feel it's a little bit overblown, because I feel like the things that people loved about cities are going to come back, and people are going to want to experience those things. So I don't know.
I
We'll see.
agree.
I know
I agree.
yeah,
I agree. I think this, once there's more confidence in, some of I think corporations require their employees to return back to work. That's going to be the real test. And we'll see a structural shift back to the cities to a certain extent. There's going to always be that one renter that holds down, decides, what, this lifestyle is, worth a 25% discount to what I was making maybe in New York City, and now I have a better quality of life. The only other thing that, which is driving a lot of the single family rentals is just the aging population in general, selling,
right,
taking advantage of this peak single family rental market. I mean, prices are up, I think on average 12% across the country year over year, which is astounding. And I think largely driven by low interest rates. So I think people are realizing, well, why don't I sell at the top of the market and look at it? It's a renting option. So, but I want more of a home feel with a yard because I have a pet or I have children. So I think, or grandchildren. So I think that that's going to be, like we're seeing that single family rental momentum pick up. And I think that is probably here to stay, just given home ownership rates will probably stay more on the lower end of historical averages than not. Just affordability is just becoming more, constrained and limited, right? In terms of being able to raise, and save, incomes aren't growing as fast as rents or home ownership of single family homes. So I think that that's something to keep a watchful eye on.
So looking back at the institutions themselves, the clients that you're talking about, you mentioned that they actually are also raising funds now too. Given the money that they're maybe already had, the capital that they already raised, plus this new funds, what kind of pressures are they facing? Pressures in terms of money that needs to be invested by a certain date, or on the flip side, funds that need to be sold out by a certain date? Are there any kind of time pressures that are factors in how and what kind of transactions may be happening in the next 6 months?
Oh, great question. I think generally the institutional investors are looking for opportunities. They're always looking at risk profiles too. I think there's pressure to deploy capital, but smartly. So I don't think that they're more of a defensive investor on average, I would say, and they may look at risk and more, value add or opportunistic, but generally they're looking to make good decisions. So I don't think, they want to invest carelessly. So there's no added pressure necessarily to put money to work, but there's a desire to put the money to work. And I think that they find there is opportunity, and it may look different to different investors. And I think that's important because the risk tolerance is just different across the spectrum. But, there's just so much money that, some of these larger institutional investors are sitting on. So there's a strong desire to put that money to work. Just, tying it back to multifamily, we're seeing investors are looking to invest across life cycle. So you still have those, core investors that are looking for more core profile type of transactions, lower risk, more income oriented. That's more of like a coupon clipper, and they may hold that 10 plus years, and that's okay. They're not looking the money, they want that money to kind of sit out there and kind of earn that current income return that they're projecting. And then you still see the value, the value add strategy being employed, although that's getting a little difficult to identify just because yield compression and cap rates are just at all-time lows. So there is that value investor, and that may be shifting in terms of we would hope to get the value pop, but we're okay with the underlying investment generating more of a current income return. But as things continue to evolve, if there's an opportunity to redo kitchens or bathrooms, or I would say like install carports or some other type of amenity to raise rents, they're looking at that. And then largely we're undersupplied, just in terms of number of units and the demand for apartments across the country. So we're seeing a lot of interest in ground up development again. So I think that that's going to be a way for them to generate higher returns, is taking construction risk with a developer or a sponsor. But also one thing that I wanted to touch on is ESG is just becoming more apparent and important to investors, that there's an environmental, social, and governance component to the deal. So on environmental, looking at green practices or sustainability, or acquiring or building to LEED certification, or on the social aspect, looking at affordable housing, either with a capital A or lowercase a, and just investing back into communities. So I think that you're seeing great pressure from the institutional investors to allocate capital to managers that have strong ESG protocols in place and are looking to improve the quality of housing across those segments and the communities that some of these residents live in.
Yeah, that's an interesting point, because I would think like some like institutions, especially, like maybe not ever, there's a lot of talk about ESG, and for some investors that might just be a good to have, but for institutions, I think some of them are facing like real mandates around
Very much so. Yeah.
around doing this. So that is a real thing that, and it seems like it could be a difference maker for a deal, or for a real estate firm that's looking to raise money, if they can like really separate themselves on this front.
Oh, I totally agree. And, and again, now that there's just so much focus on it, there's more transparency involved, because I think, folks would come in and say, well, we're going to institute some green policies, and that may be, putting in, LEED light bulbs in, across our buildings, or water saving, toilets and whatever it may be, or just more, we're going to start recycling. I mean, these are basic things. It may seem very practical to you as an individual, but to kind of roll these out on large scale, I think that people are setting themselves apart for sure. But now you're able to kind of show from an operating performance the benefits of how actually instituting and implementing these practices have benefited the investors, and putting just increasing net operating income, reducing expenses, whatever it may be, as well as the welfare of the tenants. Like, some tenants will pay more in rent to know that they live in a more sustainable community at the property level. So I think that that's differentiating, and I think we're going to see more institutional investors talking about ESG, as well as implementing this into their everyday business plans, and then measuring it as well. And there's some benchmarks out there that are starting to follow it closely, where institutional investors are submitting their performance, and it's being benchmarked, which I think a lot of benchmarking is being done by institutional investors now, more on a portfolio basis, and that's how they're being measured, if they're performing or not. But I think this ESG component is going to play a larger role in the composition of their portfolios and how managers are being selected.
And the recycling thing may sound small, but I wrote about waste and recycling for a couple of years, and recycling at multifamily buildings is a whole thing. Like
Oh,
that
very
is,
much so.
so like that, whereas the residents of a multifamily buildings sometimes, yeah, it was just interesting to like something like I think you said that maybe you didn't think about, but actually it turns out that, when people live in homes versus when they live in apartments, somehow the way that the recycling behaviors are different, and so it becomes a much more of a management or an ad to be able to provide that and get the waste and recycling handled correctly at a multifamily building.
For sure.
So one other pivot, I wanted to make another pivot here, which is, okay, so now, talking about your clients, again, with this context of this past year, has that relationship evolved in terms of the way that the communication and the reporting happens and just the cultivating of those relationships? And are there things that are, even as we get to, real estate's an industry where people do deals face to face and all, and I think everyone's gonna still do a lot of that, visiting sites, and we're going to do more of that now. But are there ways that relationship evolved in the past year that you think will, new things that were important or things that may stay even as we move back to a greater sense of normalcy?
Yeah, I agree with you. And I think it's important how we've distinguished ourselves at Berkadia is we find and feel we are more advisors to our clients than brokers. And that's how like we distinguished ourselves. And that advisory role is just going to become more important as investors become more sophisticated. And we're finding institutional investment portfolios are becoming less about transactions and deals, like less deal focused and more about strategy and how to kind of find that marginal difference in performance. So that we've taken that role on, and that's and I think in this changing world, post COVID, climate change, investors need to develop a strategy and hang every acquisition they make onto that strategy because they're going to be measured. So we are doing that, and bringing those actionable insights to our clients to help them make better real estate decisions. One way that we're doing that is we've made a significant long-term investment in technology and proprietary data to develop a unique and fully integrated platform that marries our local real estate expertise with our capital markets knowledge. So there's just, I would say, there's just a heightened focus on cutting edge technologies like machine learning, artificial intelligence, automation, and blockchain that will be, vital to moving commercial real estate forward and helping organizations provide value to its clients as they manage deal flow.
Yeah, it just seems like such an interesting, time, because this industry for a long time seemed to be very tech averse, and now, but there was all this information, and now turning that, like I think, like you're talking about, turning that information into intelligence, turning it into ways that can improve processes and improve the way that you're serving clients. It's just a very interesting time, I think, to be covering this sector, to see how this stuff is now being implemented and being brought to investors and improving the way that things are happening.
Well, I think it has incremental value. Like if you could, everyone has the same, external data, right? Like you could subscribe to Axiometrics or to Yardi or to CoStar, right? So everyone's basing their decisions off a similar set of data. But if you could provide that actionable insight that may be different to help them make a better decision and incrementally drive more value, that's the differentiator, and that's what we're trying to do, is just kind of provide those types of insights to help them make better real estate decisions.
Well, this has all been, I've taken taking a good chunk of your time here. I appreciate you. I've been bouncing around a little bit, but you've answered all my questions. You've been going with me, so I appreciate you following my train of thought on all this stuff. Before we wrap up, I just want to ask if there's like anything, any points that, or any things that you think the audience should know that I have not asked you about that would be good just to underscore at this point.
We're thrilled about where the real estate market is. We don't do a lot of predictive analysis in terms of projecting, where things will be, but we're here to serve our clients, and we're trying to take that advisory role to the next level. And we're here to serve the institutional client base on a national basis. And we're excited about the way that the 2021 year has started, and we're looking forward to serving our clients throughout the rest of this year and beyond. Thanks, David.
Thank you, and good luck with this business. And it sounds like you guys are off and running, so it's going to be great.
Wonderful. Thanks again for having me.
David, this was fantastic. Obviously, you always have great conversations, great guests. David, do you have any closing thoughts for today's podcast?
No, just to thank the listeners for riding this out with us, and and if I guess it's just like, I don't know if I've actually done this kind of a plea before, but if if anybody's out there who's listening, who is interested in has ideas for guests or topics or things that we haven't talked about, just drop us a line and let us know. And thank you for continue to listen to the podcast.
Yeah, absolutely. So where should they send that information?
They could email me at Bodamer, Bodamer at inform with the letter A at the end.com.
Perfect. Again, thank you, Dori, for being on the show. David, thank you so much for bringing her on the show. And our last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This also makes it much easier to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. And we'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.
Today's podcast was brought to you by Ryan, liberating our clients from the burden of being overtaxed, freeing their capital to invest, grow, and thrive.